got an anatomy of a trade in AMD, and I gotta say, I saw this risk graph, and
You liked it?
it's a piece of art.
Oh, thank you.
I gotta say, it's a piece of art.
Thank you.
And I think the viewers will agree when they see it as well.
And I will point out that we have done a lot of anatomy of a trade, and a lot of them have been in AMD. And it's no shock that AMD is kind of a perfect trade for us in terms of, you know, it's a $100 stock. It moves between 70 and 150. You know, it's got some price movement. It's got high volatility. So right now, current implied volatility is in the 50 handle, and it uses, you know, relatively decent amount of buying power for our accounts. $1,000 in buying power to be naked in here. It's kind of like the perfect vehicle. So if you're getting sick of these anatomy of a trades with AMD, I'm sorry, but you'll probably have more in the future as well.
Yeah, I mean, two-sided action high IV.
It's perfect. You
That's
can
what
hold
we
it.
want.
You know, premium is good. You're getting dollars on all your rolls and adjustments, and entry, you know, is $2, $3, perfect. So got another one.
Love it.
Let's do it.
Let's do it. Let's do it. And it's a little bit of a different view.
We did this on the last one. I kind of like this view.
Yeah. Well, we've shown this before, but we're moving towards showing, you know, the order chains feature with the market snapshot, as opposed to the customized table that we normally have.
Yeah, the customized table, too much
going on.
It's too wordy. So this one I think fits it better.
Yeah.
All right, so this one started on the 21st. So it's been, and I closed this yesterday to finish it. So it was about, we'll call it 20 days, 25 days, something like that. So I started with just a normal Strangle. I sold the 92.105 Strangle. You can see the stock price on the market snapshot page trading at 97. So a little bit of upside skew here, which is why the call was a little bit further out of the money. When we look at the delta slide, you'll see I started with basically zero deltas. So just a normal Strangle, I guess, a little bit shorter duration with 29 days to go, but no biggie there if you're comfortable at the risk. Over the next, week and a half-ish, you had a rally in the stock up to 92, so it's rallied about five points. Rolled up that put from the 92 to the 97 strike, collected 98 cents, right around $1. Again, high premium in this underlying, $4 on entry, $1-ish on the roll-up. Again, on the third adjustment, another roll up. So you see the stock has moved from 97 to 107. It's a 10% move in the stock price, over 10% move in the span of 2 weeks, right? So outsized move for the stock, rolling up the puts, just being mechanical here, getting to that tight strangle slash straddle that we call the guts, right? So you're getting to that kind of at the money position. The fourth adjustment is when I buy the guts and sell the wings, and we'll see that on the third slide when we get to it, because I did this in two separate transactions to kind of highlight the adjustment.
Fair enough. And yeah, really just looking at the way that this thing has moved, and you can see it moved from 97.5 to 107.5. I mean, you should expect these kind of movements with a high IV stock. Yeah. It's pretty rare where you have high IV and it doesn't move at all. You should expect some chunks here and there, but you're getting paid to take the risk in being involved in those chunks, I guess you'll say.
Yes. All right, so jumping to the next slide. So this is the delta of the positions of the position and the adjustments that I'm making. So you can see I start with basically zero delta, right? It's I think I was selling maybe the 25 delta on either side, maybe the 30 delta. It doesn't really matter. Position's flat. The next adjustment, the stock or the position has a 15 delta, so I'm reducing that by 15. The third adjustment, again, you can see the position's delta isn't getting to 100 or 50. We're sitting around 10 or 15. I'm leaning a little bit directional into the move in the stock, and you can see on the close of the trade, I'm getting pretty heavy delta. That's when I decide to take this position and roll it out in time, which is what we'll see on the next slide here. So here, the position on the bottom, the 102, 105, that's the guts trade, right? So when Tom says buying the guts, selling the wings, that is the guts part of the position. It's an at the money position. The stock is trading somewhere around 103 or 104, whatever the case may be. It's right at the money. I'm taking that position, that at the money strangle, and I'm rolling and selling the wings, right? I'm going to a new position that's further out in time, going out on the curve, on the extrinsic value decay curve, and getting a position that is further out of the money. I'm doing this whole transaction. You can see I did it for a small debit. I did it for a debit of 40 some odd cents, 47 cents here. But I'm essentially moving that at the money premium, which is going to be slow to decay and is going to move quicker because it's in the shorter duration, 11 days at that point. I'm rolling that to out of the money premium on the longer duration here to a new position. And you can see it establishes back my zero delta. I'm going from a position that was slightly short delta to now a flat delta position further out in time, that out of the money strangle.
Love it.
So, and then when I close the position, you could see over the next week, the delta of the position didn't change. The stock floated around, right? And that would have had a big change in my delta if I had stayed with the position, because the stock got up to like 110-ish, was kind of the high. It's trading at 105 right now. So if I stuck with the 102, 105, I would have been 70 deltas short into a move to 110 with just a couple days left to go till expiration. So you can see over the next week, even though we had the price movement, the delta of the position when I closed it yesterday, when the stock was at 107, was basically still flat.
Yeah. And doing your best to avoid those tough decisions. I don't think we talk about that enough, but like sticking with the 102, 105, basically a straddle, if you get a big move against you, now you're kind of pushed into a corner and you're like, okay, what am I going to do now?
Yeah.
Where understanding that you can move from the 11-day to the 30-day and basically turn your 3-point wide inversion into a 25-point wide out of the money strangle range.
I wasn't inverted, but tight. Right at the money.
Yeah. Basically a straddle.
Yes.
Going from a virtual straddle into a 25-point wide strangle for ultimately a scratch, we'll call it. Mm-hmm. Buying it back for 555, selling for 508. Now you put yourself in a situation where you can absorb a lot of volatility and you don't have to make these tough decisions.
Yes.
So I think that's another thing that we should bring to light. But I'm very excited for the last slide because this is just work of art. Yeah.
So here is visually what buying the guts, selling the wings is doing. So you can see the value of my position in terms of credit isn't really changing. Right, so like the break-even point from where my short strikes isn't moving, because you're doing this for a net small debit. You can do it for a small credit, or maybe you do it for a scratch. It's a negligible amount, so it's not adding potential value to pull from the trade, but it's moving where my risk is on the trade. If you would kind of you would think that I would get maybe $3 or $4 of premium if I had just rolled out in time to the at the money straddle, which would put me at a pretty wide break even, but that position wouldn't decay as quick as that further out of the money position, the wings position in this case. So you're moving from that very tight range to a much wider range to allow for some price action in between.
Yeah. And one thing will always ring true with these visualizations that we do with undefined risk short premium trades that we're rolling, and basically we're moving these break evens wider and wider and wider because we're staying in the trade, we're collecting more premium. We can adjust our strikes as we see fit wherever we want to move our risk, but at the end of the day, as long as we're picking up credits and not paying debits, our break evens, the green dotted lines here, are going to continue to just move further and further from the stock price, which means over time we can absorb a lot more volatility and we'll still be okay in the sense that our credit is greater than the volatility that we're absorbing, and our break evens just get further and further away. Mm-hmm. And when you put yourself in that scenario, assuming you have a stock that has two-sided action, it just makes it a lot easier to be profitable at the end of the day.
Beautiful.
Glorious.